All right, folks, part 5, long chapter here, chapter 9. Now we're going to take a look at goodwill. So goodwill, hopefully if I get this thing turned on, okay. So goodwill, what goodwill is, when you buy a business, okay, and you buy the assets of the business, but what you pay for the assets is more than the fair market value of the assets. So basically, like here, you're paying $250,000 because of a business. You're buying a business for 250, but all the assets are 175. So I'm sure some of you are thinking, well, why would anybody do that? Well, let me give you an example. Let's say you went to buy a Subway sandwich shop. They're easy to figure out. Everybody knows what Subway is, right? So you go to buy it, and all the assets, the ovens, and blah, 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 and all that stuff is worth $200,000. And you're like, well, I only want to pay $200,000. But the guy's doing $1 million a year in business and it's highly profitable. Why would he sell the business to you just based on the value of the assets? Because he's also making a lot of money on the business. So that's what goodwill is. Okay? That's what goodwill is. Okay? So when one company buys another company, it's not amortized. Okay? Only purchased goodwill is an intangible asset. What they do is they check it for impairment. Impairment means it's diminished. And what they mean by that, so let's say for argument's sake, what would be a good example? Well, okay, a while back, Nike got in trouble because they hired kids. I don't know, in some of the foreign countries, they had children manufacturing their shoes. Right? So that's a problem because a lot of places in the world are like, well, wow, that's not cool, and they're paying them like $1 a day or whatever. So technically what that could do is it could hurt the value of Nike because of the impression of Nike in the world. So goodwill is kind of like, it's an intangible asset, you can't touch it, but you could potentially hurt your business, like hurting the name of your business. It's like that, okay? That's what they're getting at there, okay? So here you go, company valued at $10,000 is sold to another company for $15,000. How much goodwill is in the transaction? The assets are valued at $10,000, sold for $15,000. Okay. Question number 6, going to be on your quiz. Okay. So with limited life tangible assets, okay, they purchased the patent for a water coaster for $800,000. They intend to use it for 20 years. So they got a patent. Okay, so each year what the company's going to do, they're going to amortize it, accumulated amortization, right? Contra asset and amortization expense. It's this contra asset is a contra to the actual item, okay? And they're going to, just like depreciation, it's the same thing. Amortization is depreciation for an intangible asset. That's it. No different. They just call it a different name. Why? I don't know. I guess to make it difficult, I don't know. All right. So here's a summary. Definitely, like when you go to take your test, you're allowed that one sheet of paper. You might want to have some of these things on there if you can't remember them. Okay. Good things to know. Now we're going to take a look at something. We're going to take a look at the fixed asset turnover ratio. Again, anytime you see the word turnover, it's how fast. And basically what they're getting at here is how much of all your fixed assets, what is the return on that? How fast and how much, okay? So, for example, you take the net revenue of the company and you divide it by the average fixed assets. And how you get that, you got to go to the beginning balance sheet and the ending balance sheet and then just divide by 2. So notice it measures the sales of dollars generated by each dollar of fixed assets. It's kind of like this. Let's say I told you you could buy 2 restaurants. The assets for one restaurant were $50,000, and the assets for the other restaurant were $100,000. And I told you that you would do $500,000 in sales with each one. Well, if you stop and think about that, why would you want to spend $100,000 to generate $500,000 in revenue when you could spend $50,000 to generate $500,000 in revenue? Basically, it's saying how well are you utilizing these assets? Are you utilizing them well? Okay. So they give us some information here about Cedar Fair. So here you go. Here's Cedar Fair. There's their revenue. But make sure this is on before it goes crazy. Okay, so there's their revenue. There's their fixed assets. So they average these two. Comes out to 0.85. Six Flags, 0.18. Facebook, 2.1. So Cedar Fair and Six Flags, those are the same kind of business, basically. You know, they're amusement park type business. So you could say from this that Six Flags is doing a better job using their assets, okay, at least in this time period. Now Facebook here, Facebook really is not a good comparison. Why? Because it shouldn't even be compared to these two companies. It's not the same thing, okay? So it's really not a fair, it's not fair to compare the two. Do you know what I mean? Right? In certain industries or certain ways, and that's just all there is to it. All right, next we're going to take a look. What happens if there's a change in depreciation? What happens if we have to revise our estimate? It happens. You know, we think it's going to last 5 years, turns out to be 8. Okay? So here's the general rule. Just to let you know, here's the general rule. The general rule is you stop right where you're at and you recalculate. Okay? So it's kind of like this. Okay? So remember, residual value, it's a prediction. You don't know for sure. The useful life, it's a prediction. And the estimate, and depreciation's an estimate, so sometimes they have to be revised. I mean, we don't have crystal balls. If we did, everybody would always make money in business. Nobody would ever lose, right? So, it says here, Cedar Fair purchased equipment that cost $60,000. Estimated useful life for 20 years. Estimated salvage value of $3 million. Shortly after the start of year 5, Cedar Fair changed the initial estimate to 25 years and lowered the estimated salvage value to $2.4 million. Calculate depreciation expense for year 5 using the straight line method. So what they did here, this was shortly after the start of year 5. So they want you to do year 5, but with the new numbers. So here's what happens. Okay. So the original depreciation, so far they started with $60,000, right? So the original depreciation was minus the salvage value. So this is the original cost minus the salvage value times 1/20th. The depreciation for 1 year would be $2,850,000. They've depreciated it now for 4 years, so it's $11,400,000. So now we take the acquisition cost, we subtract that accumulated depreciation, and this is our new book value. Now we have to go and calculate again. So what we do is we take our new book value, we take our new residual value, right? And now we've got 21 years left. So you take 121 and we're going to depreciate it this much per year. So it's going to be $2,200,000 per year. See how that goes? You basically stop. You take away the depreciation that was already there, which is this. You take that away, you got your new book value, and then you have to look how much time is remaining. So remember, they've done 4 years already, and they say it's going to last for 25. That 25 included that 4. They didn't say 25 more years. They said 25 years. So be careful with that. Okay? All right, folks. That's it for part 5. We're going to come back with solve problems in just a minute.